Hello everyone, you're very welcome back to the channel. Today we're answering the question, how worried should homeowners be about rising interest rates? Whether you're a first-time buyer, a second or subsequent buyer, a buy-to-let investor, or even a prospective home buyer, rising interest rates are a cause for concern. If you're a current homeowner, your primary concern is the household budget and the impact that rising rates will have on household spending. If you're a prospective homeowner, your primary concern is affordability and mortgage eligibility. And for investors, the concern is total returns and whether, in light of rising rates, better investment opportunities exist elsewhere. In each of these cases, although the concerns may differ, the cause for concern is the same. The goal of this video is not to dispel these concerns because they are legitimate. Rather, the goal is to help homeowners to better understand why rising rates are a cause for concern in the first place. From that place of understanding, homeowners can then accurately assess how much cause for concern is warranted in the context of their own personal circumstances. Because concern which stems from understanding is much healthier than concern, or worse yet, a lack of concern which stems from misunderstanding. Let's kick things off by talking about the relationship between interest rates as set by the European Central Bank, or ECB, and mortgage rates as set by the banks. The ECB provides funding to the European banking system, which in plain English just means that European banks can borrow money from the ECB. When a bank borrows money from the ECB, it pays what's known as the main refinancing operations interest rate. This interest rate can and has changed over time, going from 0% in 2019 to 3.5% as of March 2023. The basic function of a bank is to borrow short and lend long. Therefore, it's reasonable to assume that a bank will seek to lend out any money that it acquires from the ECB to its customers. Logically, the bank will want to earn a rate of interest on this lending that equals the main refinancing operations rate, which it's paying to the ECB, plus an additional percentage as profit. This is why changes in ECB interest rates can impact the interest rate that banks charge on the loans that they make, including mortgages. If the main refinancing rate is high and or rising, then banks will want to charge higher interest rates on loans because they themselves have to pay a higher rate to the ECB to borrow money. If the main refinancing rate is low and or falling, then the opposite is true. Banks can charge lower interest rates on loans because they themselves can borrow money cheaply from the ECB. Changes in ECB interest rates not only impact interest rates on loans, but also currency exchange rates, asset prices, consumer and investor behavior, and the availability of credit. The main refinancing rate is but one of the three key ECB rates. When the ECB makes a decision to increase rates, say by 0.5%, each of these rates will typically increase by 0.5%, including the deposit facility, i.e. the deposit interest rate. This is the rate of interest that banks receive when they choose to store their excess cash with the ECB. The deposit interest rate set by the ECB can influence the rate of deposit interest that banks offer to their customers on deposits. Despite an increase in deposit rates being a positive outcome for depositors, it can also explain why banks may want to increase interest rates on their loan products. If a bank is paying a higher price to receive cash from depositors, i.e. deposit interest, then the bank will want to receive higher interest payments on loans to compensate for the higher costs. Given that many banks rely on customer deposits for the bulk of their cash, offering a higher deposit rate can have a big effect on profitability if a corresponding increase in the returns on loans and other bank investments is not seen. That begs the question, why are ECB interest rates and consequently mortgage interest rates increasing now? One word: inflation. I'll spare you the full recap because we're all aware that inflation has been persistent over the past 2 years. Controlling Eurozone inflation is the responsibility of the ECB, and the ECB uses interest rates to exercise that control. If the ECB wants to encourage borrowing and economic growth, they will reduce interest rates, thereby making it more affordable to borrow money. However, if economic growth becomes excessive and the economy starts to overheat, as characterized by rising inflation, then the ECB will increase interest rates in order to reduce demand and curtail this effect. That's essentially what's been happening over the past year. The ECB has been increasing interest rates since last July in a bid to tame Eurozone inflation and to bring it back in line with the ECB's target rate of 2%. Before the most recent rate hike, the ECB noted that inflation is projected to remain too high for too long, and as a result, each of the three key ECB interest rates were increased by 0.5%. The key thing to understand is that controlling inflation is the primary motive behind any ECB decision to increase interest rates. So with that being said, let's take a look at the various ways in which homeowners are affected by rising interest rates, starting with mortgage repayments. The effect of rising interest rates on your mortgage repayments will depend on the type of mortgage that you have: fixed, variable, or tracker. Fixed rate mortgage holders are insulated from the effects of changing interest rates for the duration of the fixed term. Your mortgage interest rate is fixed at a given percentage, and that's the rate that you'll pay for the duration of the fixed term. It's important to be aware that fixed rate mortgage holders are protected from both positive and negative outcomes arising from changes in ECB interest rates. So for example, homeowners who locked in fixed rate mortgages prior to July 2022 are benefiting greatly because their mortgage repayments have been fully sheltered from the effects of rising rates. However, their fixed rate term will inevitably come to an end in the future, at which point they'll need to either refix or move to a variable rate contract, which will likely come at a higher cost. Conversely, homeowners who are locking in fixed rate mortgages in March 2023 are doing so at much higher rates. Whether or not that proves to be positive or negative will depend on the future direction of interest rates. A downwards trajectory will be bad news for fixed rate mortgage holders, while an upwards trajectory will be good news. Tracker rate mortgage holders are the group most exposed to the positive and negative outcomes arising from changes in ECB interest rates. With tracker mortgages, your mortgage rate, and hence your monthly mortgage repayment, is directly tied to another predetermined rate. This predetermined rate is typically the main refinancing operations rate set by the ECB. So for example, because the ECB increased interest rates by 0.5% on March 16, 2023, tracker rate mortgage holders can expect their mortgage interest rate to increase by 0.5%. They feel the full brunt of rising rates long before fixed rate and variable rate mortgage holders. Seeing as the ECB has increased interest rates on 6 separate occasions since July 2022, tracker rate mortgage holders have been having a not so good time. Then we have variable rate mortgage holders, and this is where things become somewhat more complicated. There is a common misconception that an increase in ECB interest rates will invariably lead to a corresponding increase in variable mortgage rates and mortgage repayments. However, this is not always the case. In fact, that'd be more akin to a tracker rate mortgage than a variable rate mortgage. With a variable rate mortgage, banks have the option to increase mortgage rates if they so choose, but there is no obligation to do so. Irish banks have been the case in point examples. AIB was the first Irish bank to increase its variable rates in March 2023, 8 months after the first ECB rate hike. The increase in AIB's variable rates was only 0.35% as compared to the 3.5% increase in the ECB's main refinancing rate since last July. So the obvious effect of rising interest rates is that it can lead to higher mortgage repayments. That's especially true for those on tracker mortgages and those looking to fix or refix at a point in time where interest rates are higher than before. The knock-on effect of higher mortgage repayments is that households have less of a capacity for spending and or investing. If more of your income is being allocated towards paying off the mortgage, then naturally you'll have less money to spend elsewhere. That problem is compounded when you factor in the environment that high and rising interest rates tend to exist in, an environment characterized by inflation. Not only is the household paying a higher monthly mortgage repayment, but they're also fronting the cost of higher utility bills, grocery bills, and all of the other essential and discretionary costs which have been impacted by inflation. And that's especially true for low-income households. However, as we mentioned earlier, an increase in the deposit interest rate as set by the ECB can be favorable for depositors if banks choose to pass on the higher rates to customers. If this was to happen, then households could take some degree of solace in the fact that their deposits are now earning more money than they were before. Unfortunately, in practice, this isn't always the case. As was noted in the ECB research paper, Who Bears Interest Rate Risk, banks' market power results in limited pass-through of market rates to to deposit rates so that deposits effectively behave like long-term fixed rate liabilities. In other words, households are much more likely to feel the negative effects of rising rates through higher loan costs than they are to feel the positive effects through higher deposit rates. What about house prices? How are house prices affected by rising interest rates? The expectation is that as interest rates rise, house prices should decline. Reason being, the cost of the mortgage required to purchase the home has increased, therefore making the purchase unaffordable for certain segments of the prospective home buyer market. That reduction in demand, if large enough, can translate into a decline in house prices. Remember, for prospective home buyers, a decline in house prices is not always favorable if it's accompanied with higher interest rates. The net outcome of higher rates on a smaller mortgage might actually be worse than the net outcome produced by lower rates on a larger mortgage. Regardless, for existing homeowners, rising rates can reduce the value of your home, thereby reducing the amount of money that you could reasonably expect upon sale, or the amount of cash that you could expect to receive by releasing equity in the home. With all of that being said, what does the future have in store for interest rates, and how worried should homeowners be? It's important to be aware that any discussion about the future of interest rates is pure speculation. Nobody knows for certain what's going to happen in the future. However, we can make some educated guesses to guide our concerns. Eurozone inflation fell to an annual increase of 6.9% in March as compared to 8.5% in February. That decline is almost entirely attributable to energy inflation, which fell from an annual increase of 13.7% in February to an annual decline of 0.9% in March. When you look beneath the hood, you'll find that food, alcohol, and tobacco inflation stood at 15.4% in March. That's the real problem, one which the ECB will be keen to solve. Philip Lane, the ECB's chief economist, has said that more interest rate hikes will be needed to get Eurozone inflation down to the target rate of 2%. So while we don't know for certain what the ECB will decide at its next meeting in May, it's fair to assume that more rate hikes are coming. What does that mean for homeowners? For prospective homeowners and homeowners coming off of fixed rates, it will likely mean having to fix or refix at rates that are higher than those that are currently on offer. For tracker mortgage holders, it will definitely mean an increase in your monthly mortgage repayment if the ECB's decision is to increase rates. And for variable rate mortgage holders, it will be at the discretion of the bank with whom you have your mortgage as to whether or not your monthly mortgage repayment will increase. As for how worried you should be, even though rising rates are objectively bad news for mortgage holders, the average mortgage holder will be just fine. I'm in no way underplaying the financial burden that rising rates place on households. However, you have to remember that the bank's decision to lend you money in the first place was predicated on your ability to afford repayments even when rates are rising. So, excluding any unforeseen financial burdens like loss of employment, you should be able to get by. And because of that, there's likely no need for excessive worrying. But let me know, what are your thoughts on rising interest rates? Have you felt the effects of higher rates on your monthly mortgage repayment? Are you on a fixed, variable, or tracker rate mortgage? Let me know in the comments. Before you go, you might be interested in this next video, which talks about the recent string of US bank failures and what they could mean for Europe. Thanks very much for watching, and I'll see you soon.